Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. Finally, we are going to continue with the CA Intermediate Income Tax batch for May 25, September 25 and Jan 2026 examinations. Fine. In the previous videos, we had discussed about Income Tax Act and Income Tax Law. We had discussed that both are not one and the same. Income Tax Law is a much wider term and Income Tax Act is only a component of the Income Tax Law. Whereas there are 4 other components also. What are they? Finance Act, Income Tax Rules, Circular Notification and Decision by Courts. We had discussed all of them in the previous videos. I hope you are able to recollect it. If you are not able to recollect it, my advice would be, because it has been a while since the previous video was uploaded, so I would recommend you to go to the previous videos once quickly and watch the video at 1.5x or 2x speed so that you can recollect the concept, and now you can continue from there. Okay, so today we are going to discuss your entire income tax syllabus within just half an hour. Kanna, sir, how entire syllabus? Answer is because in the steps to calculate total income and taxes, which we are going to discuss now, your entire syllabus is covered. This number 5, number 7, number 8, etc., which I have written here is nothing but your chapter numbers. And after this video, you will be knowing what is the link between the various chapters that you are going to study and why you are studying those chapters. And after studying, how you should implement those chapters while working and doing the tax calculation. Fine. So let us now begin the steps to calculate the total income and taxes. So for income tax to be there, firstly you should know what is the income. After knowing what is the income only, you have to know what is the tax rate. Based on the tax rate, you will apply it on the income and then you will find the total tax. It is as simple as that. Correct? Answer is no, Kanna. There is a little complication involved. So let us discuss all the steps one by one. Then you will be able to appreciate what are the various sections that you are going to study in this syllabus. Firstly, step number 1, person. Step number 1, person. So first and foremost, you have to determine what type of a person the assessee is. Sir, assessee? Assessee means what? Assessee. This assessee word we are going to hear a lot of times when we are going to go through our syllabus. I am going to teach you assessee in detail. However, for now, for the time being, please understand that assessee means taxpayer. Okay. So first and foremost, we have to determine what type of a person the assessee is. Whether the assessee is a good person or whether assessee is a bad person. I am joking. Good person, bad person, appromel vechikla. But however, the person meaning in your mind and in the definition as per Income Tax Act is a little bit different, Kanna. We feel that we know that person means a person like me and person like you. But in the eyes of Income Tax Act, me and you are not persons, me and you are individuals. Okay? And person is a much wider meaning, because in Income Tax Act, person includes company, HUF, individual, AOP, BOI, firm, LLP, artificial juridical person, which we are going to study in the course of the next chapter. So all these different types of persons are there, and for every type of person, the rules to calculate the income tax and the rules to calculate the income is completely different. Hence, firstly, you have to know for whom you are going to calculate the income and income tax. So first determine what type of a person the assessee is. Okay. After that, step number 2, you have to come to residential status. You have to determine whether the assessee is a resident or non-resident. Whether the assessee is a resident or non-resident. A taxpayer is a resident or non-resident. Sir, what is this resident? What is this non-resident? This resident and non-resident meaning we are going to learn in residential status chapter, Karna. However, for now, let me tell you that if a person is a resident, then for that person, global income, that is income earned in the entire world, is taxable in India. However, if a person is a non-resident, then for such person only Indian income is taxable in India. Hence, it is very important to determine whether a person is resident or non-resident. For a resident, entire world income will be taxable. For a non-resident, only Indian income will be taxable. Fine. Then step number 3. After finding the person and residential status, after knowing the residential status, you will know what and all incomes are taxable, what and all incomes are not taxable. Because whether global income we should take or only Indian income we should take, that you will know. After knowing what and all incomes are taxable in the income tax law in India, you have to divide the income into 5 parts. You have to divide the income into 5 parts. These 5 parts are only called 5 heads of income. What are they called? 5 heads of income. Please write this. 5 heads of income. These heads of income are only the heart of the Income Tax Act. So you have to divide the income into 5 heads of income. The first head of income is called salary. First head of income is what? Salary. So for salary income. Okay. But is it only salary income? Answer is no. This salary is an entire chapter which is more than 100 pages in your syllabus. So many different things we are going to learn when it comes to salary. Not only the amount that is monthly credited in the bank account of an employee, there are other things also which may be coming into salary. We will learn all of that in depth in the salary chapter. Then the second type of head is called house property. House property. House property means what? If I want to tell in very simple language, it means nothing but rental income. Rental income. So first one is salary income, second one is rental income. What about the third one? Third one is PGBP. PGBP means, and one more thing, this PGBP, HP, all these words I am only using because I want to cut short the notes so that it is all adjusted in one page. But when you are writing in the examinations, you definitely have to write the full wordings. Wherever abbreviations are allowed in the examination, I will be telling you where and all you can use short forms. But if I am not telling you that you can use this short form in the examination, then please don't use it. It is just for making the book short enough so that the entire concepts are fitted in just a single page. I am using short forms. Okay. So profit and gains from business or profession. Business or profession. So basically the income coming from business or income coming from profession is covered in the PGBP head of income, profit and gains from business or profession. Then the fourth head of income is capital gains. Capital gains. In school, when you had studied accounting, you would have learnt about capital assets, the assets which are shown in the balance sheet. And if those capital assets are sold and if there is a profit, such profit is called what? Capital gain. So it is capital gain. This capital gain is also a wide chapter. There are loads and loads of concepts that we are going to cover, and don't worry, in detail we are going to cover because there are many amendments also, and whether you are lucky or unlucky I don't know, but most of the amendments are in between the year. So since it is in between the year, you have to learn what is the previous position also, what is the new provision also. So for half of the year, previous rules will apply, and for the remaining half of the year, new rules will apply. So both rules you are going to study because you are only coming in the transition year. Okay. Next, income from other sources. The last head is what? It is income from other sources. Income from other sources. So if any income is not coming under any other head of income, then such income will come under the head of income from other sources. Hence it is also called as residuary head. Residuary head of income means if you are not able to put it under any other head, then you will put it under income from other sources. However, there are certain types of income which is only taxable under income from other sources, like dividend income. Dividend is taxable under income from other sources. Okay, we are going to learn this also when we are going to study the income from other sources chapter. So now you got it. So based on the residential status, you will know what and all incomes are taxable. Those incomes you are going to divide into 5 categories. They are called 5 heads of income. So first head is called salary, second one is called house property, third one is called profit and gains from business or profession, fourth one is called capital gains, and fifth one is called income from other sources. So tell again once again with me: salary, house property, profit and gains from business or profession, capital gains, and income from other sources. Okay, so these are 5 heads of income, very important. Then, sir, you can also reduce the deductions and you need not tax the exemptions. Sir, what is this exemptions and deductions? Kana, let me tell you the difference between exemption and deduction. Exemption means an income which is not taxable in the Income Tax Act. Exemption means an income which is not taxable. For example, agricultural income. If you have any income from agriculture, it is not taxable in the Income Tax Act. So it is an exempt income. It is called exemption. Sir, what about deduction? Deduction means an expense which is allowed against the income. An expense which is allowed against the income. So for example, if in a business, if you are having sales of rupees 1 crore, okay, and your purchase is rupees 80 lakhs, fine. So this 8, and then what is your net profit? Your net profit will become 20 lakhs. Assuming that there is nothing else. So sales is equal to 1 crore, purchase is 80 lakhs, then your net profit will become how much? 20 lakhs. Hence, what is this purchase? This purchase is only deduction. Deduction means the expenses that you can claim against the income, you can reduce it from the income, and finally the net income is only going to be taxed. So what is the difference between exemption and deduction? Exemption is an income which is not taxable. Deduction is an expense which is availed against the income. You can reduce it against the income. You get my point? So after finding what are all the incomes, then you have to see what are all the exempt incomes. So for the exempt income, you should not calculate the tax, and you should find out what are all the deductions. What are all the deductions? You can reduce it against the income, and only the net income is going to be taxable. Okay. Now we'll come to next step. The next step, or step number 4, is called clubbing. Next step is called clubbing, and it is also called income of other persons included in assessee's total income. Income of other persons included in assessee's total income. It is what? Clubbing. Sir, what is this clubbing? Kanna, in income tax, no, what people will do, people do not want to pay the taxes. They want to save their income tax. So whatever income they are having, no, for not paying the taxes, they will try to shift their income to other people so that they can avoid paying the tax. You get my point? So if I am earning some income and if I don't want to pay the tax, I will cheat the government and I will try to show that this is not my income, this is somebody else's income. The government is also very smart. They have introduced the clubbing provision by which you cannot do such type of cheating. The other people's income will also be included in your income only. So for example, Mr. Ganesh is having a 6-year-old child. 6-year-old child. Okay. So let's say Mr. Ganesh is having 1 crore. Okay. And in 1 crore he has deposited in a fixed deposit. On this fixed deposit he is earning an yearly interest of 7 lakh rupees. 7 lakh rupees. So Mr. Ganesh, what he will do, since he does not want to pay the tax, what he will do, instead of having the fixed deposit in his own name, he will have the fixed deposit in the name of his 6-year-old son. So the interest of 7 lakh rupees will become his child's income, and by doing this he will try to avoid to pay the taxes. But in income tax, you cannot avoid to pay the taxes if you have earned the income. Hence, this 7 lakh also, even though the fixed deposit will be in the child's name, the income will be taxed in the hands of the parent. This is called clubbing. There are many more examples also of clubbing, which we are going to learn in the clubbing chapter. Okay. Next step, set off and carry forward. Kanna, when you are having a profit or when you are having an income, you have to pay the tax, correct? However, when you are having a loss, will the government come and give you money? Answer my question. What if you are having a loss in your business, or you are having a loss in your profession or anything else? Will the government come and give you money? Answer is no. The government knows how to collect money, but the government will not come and give you the money. It does not have that habit, and never expect it from the government also. It will only collect. Hence, whenever there is a loss, there is no refund which is given by the government. Instead, the government gives the benefit of set off and carry forward. Set off and carry forward. For example, let's say I am having rental income of 2 lakhs. Okay. And in my business, I am having a loss of 50,000. I am having a rental income of 2 lakhs, and in my business I am having a loss of 50,000. So I can set off my business loss and rental income and pay tax only on the balance rental income. This is only called set off of losses. Okay, you understand my point? This is called set off of losses. So then what is carry forward? Now let me take one more example. My rental income is 2 lakhs. Okay. And my business income is 3,50,000. It is not 50,000. It is 3,50,000. My business loss. So now can I do set off? Answer is yes, I can do set off. But now what happens? Loss of 1,50,000 is still remaining. Loss of 1,50,000 is still remaining even after doing set off. In such case, this balance loss can be carried forward. It can be carried forward to the next year. And in next year, whenever there is a profit, I can do the set off in the next year. You get my point? So the first example is for set off and the second example is for carry forward. So within the same year, if I am having an income, I can set off my income. If I am having a loss, I can set off my loss against my income. This is called set off. Even after doing set off, if there is some loss left, I can carry forward that loss to the next year, and in the next year if I am having an income, I can set off that loss. Okay. So there are multiple rules of carry forward and set off. With what income and what loss you can set off with one another, what income you can carry forward, for what number of years you can carry forward, everything we are going to learn in detail when we will discuss the set off and carry forward chapter. Okay. So now, after doing all these adjustments, first find the person, then find the residential status. Based on the residential status, find out what and all incomes are taxable. Then those taxable income, you have to divide it into 5 heads of income. From the 5 heads of income, if there is any exempt income, then don't consider it. If there is any taxable income, then see what are all the deductions. Reduce those deductions. After reducing it, you will get the net income. In the net income, you should add the other people's income, which is taxable in your hands. And then if there is any loss, you have to set off or carry forward the losses. After doing all these adjustments, you will get gross total income. You will get what? Gross total income. Then the government gives a benefit of chapter 6A deductions over and above the gross total income. Chapter 6A deductions. Sir, is it a chapter in our book? Answer is yes, it is a chapter in our book also, and similarly it is a chapter in Income Tax Act also. While discussing the meaning of Income Tax Act, we had also discussed that the Income Tax Act is divided into chapters, sections and schedules. So one of the chapters is only chapter 6A of the Income Tax Act, which contains many sections like 80C, 80D, 80E, 80U, etc. etc. There are many sections which are contained in chapter 6A. It is a group of sections. Okay. So these sections contain some extra deductions that the assessee can claim against the income. For example, if I invest my money in a life insurance policy, then the premium can be claimed as deduction. If I am taking an education loan, then the interest on the education loan can be taken as deduction. If I am hiring some employees, then if I am hiring additional employees, the amount of salary given to additional employees can be taken as deduction, extra deduction. So these are all the deductions over and above the deduction which we have already discussed. You got my point? These are chapter 6A deductions. So after reducing these deductions also, you will get the total income. You will get the total income. This income, on this income only you are going to find out the tax. Okay. But before finding out the tax, you have to round off the total income to the nearest multiple of 10. To the nearest multiple of 10. So for example, if the income is 95, 67, 472. Okay, then what will be the total income? 95, 67, 470. So what if this is 476? This will become 480. Okay, so normal rounding only you have to do. Round off to the nearest multiple of 10. It means what? That the last digit should be 0. Okay. Next, after this is done, you have to apply the tax rates. You have to apply the tax rates. Now in tax rates only, from the last 2 to 3 years, the government has created a lot of confusions and a lot of new provisions by introducing the new tax regime. So after finding out the income, what you have to do, tax rate is not very simple. There is no single tax which you can just apply and find out what is the tax. For tax, first you have to understand what regime you are taking. So there are two types of tax rates. Let me explain. Tax rates are of two types: normal tax rates, special tax rates. Normal tax rate, special tax rate. Normal tax rate for normal income, special tax rate for special income. Normal tax rate for normal income, special tax rate for special income. Sir, what is this special income? Special income are incomes for which tax rate is given specially within that section itself. Okay. For example, lottery income. Okay. Then short-term capital gain on shares, listed shares, gaming income, etc. So for all these types of income, the tax will be given in that section itself. These are called special incomes. So for special incomes, you have to apply the special tax rate. You should not mix those incomes with all other income. You have to specifically find out the tax for that income separately. That is only called special income. Then what is not special income? All the remaining income is called normal income. All the remaining income is called what? Normal income. For this normal income, you have to apply normal tax rate. Special income, special tax rate. Normal income, normal tax rate. Sir, what is normal income? For example, salary, rent, profit in business, capital gain. So not capital gain. Certain capital gains are there, certain capital gain is not there. So salary, rent, profit, okay, dividend, etc. Just a second. Yeah, dividend. So these are all normal category incomes. Now for the normal category income, you have to combine everything together and then you have to find out the tax on that income. Okay, but in this also there are two types of taxes. There are two types of taxes. One is default tax regime. Default tax regime. Second one is optional tax regime. optional tax regime. This default tax regime is also called new tax regime. This optional tax regime is also called old tax regime. Okay, default tax regime or new tax regime, optional tax regime or old tax regime. This default tax regime is also called 115 BAC, section 115 BAC, and old tax regime is provisions of Income Tax Act, normal provisions. So let me tell you the history behind this default tax regime and optional tax regime in a very short span. Okay, so earlier there was only one tax regime karna, which is the normal provision, which we now call it old tax regime. So there was only one tax regime, in which what will happen, there are many deductions, there are many exemptions. So the assessee or the taxpayer can take the benefit of the deduction, take the benefit of the exemptions, and then he can on the net income he will pay the taxes as per the Income Tax Act. This will only happen normally. Then what happened, many assessees or many taxpayer feel that this exemption and deductions are very complicated. I do not want any exemption, I do not want any deduction, nothing I want. I just want my tax to be low. I just want my tax to be low. So for such type of people, the government introduced the new tax regime under section 115 BAC. New tax regime under section 115 BAC, in which the government told, if you want to take 115 BAC, you cannot take many exemptions, you cannot claim many deductions, but you will have the benefit that your tax rate will be low. Your tax rate will be low. Hence, now the assessee or the taxpayer has the choice to choose between old tax regime and new tax regime. Old tax and new tax. In old tax, what will happen? Many exemptions, many deductions, but high tax rate. In new tax regime, few exemptions, few deductions, but low tax rate. Okay. So whatever beneficial to the assessee can choose that regime and he can pay tax according to that regime. Benefit for assessee, correct? However, headache for you people, because you are only going to advise the assessee whether they are going to take the old tax or new tax. So after inter or even now, I think many people would be coming to you and asking you whether I should take the old tax regime or new tax regime, which will be beneficial for me. So this is a hot question and definitely you should be able to answer this question. Hence, you have to learn the provisions of Income Tax Act thoroughly. What is old tax? What is new tax? What are the rules and regulations? And what is the tax rate? So you are going to study two types of tax rates. One is old tax regime and one is new tax regime. Now, new tax regime is called the default tax regime, because by default, if you are not choosing anything, you will be coming under new tax regime only. And old tax regime is called optional tax regime. It means what? If you want, you can choose the old tax also. You can sideline the new tax regime and you can choose the old tax regime and pay tax according to the old tax regime. If everything is going above your head, no, don't worry. In initial classes, it happens like that, but as and when we are going to cover those chapters, everything with crystal clarity, you are going to understand. And don't worry, I am going to make you remember each and everything also. So in exams also, you will be able to remember those properly. Okay. So you have to apply the tax rates. After applying the tax rates, whether normal or special, you will find the tax. Then on the tax, you have to add the surcharge, you have to reduce the marginal relief, or you have to reduce the 87A rebate. This surcharge, marginal relief, 87A rebate, if all this also I tell you in this video itself, it will be too much for you. So don't worry, we will wait a little, and in the coming classes you are going to learn each and everything in detail. So you have to add the surcharge, reduce the marginal relief, and add the 87A rebate, which we are going to study in a few classes. Next, after this step, you have to add HEC. What is HEC? Health and education cess. Health and education cess. Health and education cess is always 4% karna. So whatever tax you have calculated, above that tax you have to add 4% health and education cess. Okay. Then now one more type of tax rate you have to study, which is called alternate minimum tax, AMT, alternate minimum tax. So what is this alternate minimum tax? See Kanna, on one hand the government will give laddu to the taxpayer, and on the other hand the government will take back that laddu from the taxpayer. This is only called alternate minimum tax. So what is that laddu? The laddu is nothing but deductions which is given to the taxpayer. So for example, I am having a business, okay, and in my business I am having a profit of 1 crore, and in the Income Tax Act there is a section called 35 AD which gives a benefit of claiming deduction on capital expenditure also. Hence, let's say I did a capital expenditure of rupees 1 crore. I did a capital expenditure of rupees 1 crore. So this entire 1 crore I can claim it as deduction and my profit will be 0. Okay. So my earlier profit was what? 1 crore, and I took the benefit of section 35 AD which is given in the Income Tax Act, of which I got a deduction of 1 crore, and now my income became how much? 0. I need not pay any taxes. But government gave this deduction, but now they are thinking, achicho, because of this deduction we are not able to get any tax from the taxpayer. Some minimum tax we should definitely get, correct? Benefit the taxpayer should get, but however government also should get some minimum tax from the taxpayer. That's why they introduced alternate minimum tax, okay, which is called AMT, alternate minimum tax. What does the alternate minimum tax say? The alternate minimum tax tells that, let us imagine you don't have any deduction at all. So how much will be your income? Your income will be 1 crore. On this 1 crore, you pay some tax, 18%. You pay some tax of 18%, and let's say after paying 18%, your tax came to 18 lakhs. Your tax came to 18 lakhs. Fine. So whatever this difference between 0 and 18 lakhs is there, no, that you carry forward to the next year, and in the next year if your actual tax is lesser than minimum tax, you can take the benefit, you can do the set off. Let's say in the next year there is a profit of again 1 crore, and this time there is no deduction. Then the tax will come as 30 lakhs. We are just, for simplicity sake, we are assuming it as 30 lakhs, and then AMT on 1 crore will be 18 lakhs. 18 lakhs. So this 18 lakhs is there, no? We can set off against this 30 lakhs and make this 18, and you can pay only the 18. That is enough. If you are able to understand, well and good. If you are not able to understand, then also well and good, because I am not expecting at least 90% of you to understand, because you will be able to understand it in the AMT chapter when we are discussing the AMT concept. So alternate minimum tax means what? On one hand government will give one laddu, and on the other hand it will take back that laddu, telling that you have to pay alternatively a minimum tax. Okay, so this is only called alternate minimum tax. So this also you have to calculate. After calculating all this, you will finally know what is the tax that is payable. Okay, so you have to decide whether you have to choose the old regime or you have to choose the new regime. New regime is the default regime, old regime is the optional regime. So whether you have to choose default or optional. So in whichever the tax is lower, you will choose that regime because it is more beneficial to the assessee. Hence, you have to decide between default tax regime or optional tax regime. After deciding it, you will get the final tax that is to be paid. From this final tax, you can reduce advance tax, TDS and TCS. Advance tax, TDS and TCS. Advance tax, TDS and TCS we are going to learn in the respective chapter. However, for now you can know that they are nothing but taxes paid in advance. Taxes paid in advance. So advance tax, TDS and TCS is nothing but taxes paid in advance. So for example, if your tax payable is coming as 1 lakh and in advance itself already you have paid 80,000, then how much you have to pay? Balance 20,000. Correct? Your tax payable is 1 lakh rupees. Already you have paid 80,000 rupees. So now you have to pay how much? Balance of 20,000. Fine. Sir, what if tax payable is 1 lakh rupees? We have already paid 1,50,000 rupees. Then what to do? Then very simple. The government will give you a refund of 50,000. The government will give you a refund of 50,000. Very simple. So in advance, if you have paid higher taxes, you will get the refund of the excess taxes from the government. So this tax payable, the final tax that is payable or refundable, this also you have to round off to the nearest multiple of 10. It means what? That the last digit should be 0. And after doing all this calculation, what are you going to do? You are going to submit it in the return of income. Return of income. Return of income means what? Income tax return. So the assessee or the taxpayer will file the income tax return. In the income tax return, only all this information will be submitted to the government, and based on this information only the assessee or the taxpayer is going to pay the tax or get the refund. So this is only the steps to calculate the total income and taxes. So I am going to brush this up very quickly. Listen very carefully because this is very important. This is only the base of your entire income tax law which you are going to study after this. Fine. So first you have to determine what type of a person the assessee is, whether assessee is individual, HUF, partnership firm, etc. Then determine the residential status. Residential status means whether the assessee is a resident or a non-resident. Based on that, you will find what are all incomes that are taxable. Divide the incomes into 5 heads of income, namely salary, house property, profit and gains from business or profession, capital gains, and income from other sources. After this, you can exempt what are all the exempt incomes, and you can claim the expenses as deduction, which are all allowed in the respective heads of income. After that, you have to include the other people income in the assessee's total income, which is called clubbing. After doing clubbing, the next step is what? Set off or carry forward of losses. After all this, you will get the gross total income. From the gross total income, you can further reduce chapter 6A deductions. After reducing chapter 6A deductions, you will get the total income. And this total income, don't forget, you have to round off to the nearest multiple of 10. After doing round off, you have to calculate the tax on total income. How you will calculate the tax? By applying the tax rate. What is the tax rate? Tax rate can be normal tax rate or special tax rate. Special tax rate is for special incomes. Normal tax rate is for all the other incomes. For all the other income, normal tax rate is also divided into 2 categories: default tax regime and optional tax regime. Default tax regime is called new tax regime. Optional tax regime is called old tax regime. So you have to decide whether you have to take the new tax regime or old tax regime, and based on that you have to calculate the tax. After calculating the tax, you have to add the surcharge, reduce the marginal relief, or reduce the 87A rebate if there is any. After doing this, on the final tax, you have to add the health and education cess, which is 4% of the tax. Okay. After doing this, you have to also find out whether there is alternate minimum tax, and if at all there is alternate minimum tax, find out the alternate minimum tax and then decide which tax to pay, whether old regime or new regime or alternate minimum tax. Okay. After finding the final tax, you have to see what are all the taxes that are paid in advance. That tax you can reduce it, and finally you will get the tax payable or refundable. With all this information, you are going to file the income tax return. Okay. So one more time, I want you to go through this sheet. Okay, at least 2 to 3 times, not even one more time, 2 to 3 times, and get this get this image installed in your head, because the entire income tax act, this is only the crux. Based on this only we are going to study, and this will be helping you even for your 14 mark question which is going to come, that is compulsory question which is going to come in your examination. Okay, so see you in the next video, Kanna. Till then, take care. Bye bye.